So you've got $10,000 to invest, but you're wondering where to put it. Should you go all in on the tech-driven VGT or play it safer with the dividend-focused SCHD? Well, in this video, we're going to break it all down so you can make the best decision for your investment strategy. By the end of this video, you'll know exactly which ETF, VGT, or SCHD aligns better with your financial goals. And trust me, the difference is huge. One could potentially turn your $10,000 into over $2 million, while the other can set you up with a solid $25,000 per year in dividends. Plus, if you don't have $10,000 to invest upfront, I'll show you how you can still hit these targets with as little as $150 per month. Let's dive in. Before we dive into the specifics of VGT and SCHD, let's talk about why ETFs are such a powerful investment tool. ETFs, or exchange-traded funds, offer a way to invest in multiple companies all at once, making them a fantastic way to diversify your portfolio. Unlike picking individual stocks, where one bad pick could wipe out your gains, ETFs spread out the risk across many stocks. Plus, they're cost-effective, tax-efficient, and require little to no active management. Essentially, ETFs give you the best of both worlds: diversification and convenience. Now that we understand why ETFs are so powerful, let's get into the two contenders for today: VGT and SCHD. VGT is a technology-focused ETF, meaning it invests almost entirely in tech giants like Apple, Microsoft, Nvidia, and Broadcom. Since its launch in 2004, it has grown to manage over $74 billion in assets. This ETF is all about growth, meaning its returns can be massive, but so can its volatility. On the other hand, SCHD is a dividend-focused ETF that tracks the Dow Jones U.S. Dividend 100 Index. It holds well-established companies that consistently pay dividends, such as Texas Instruments, PepsiCo, and Lockheed Martin. This fund prioritizes stability and income, making it an attractive option for long-term, conservative investors. So, which one is right for you? To answer that, let's compare them across key categories: risk, returns, diversification, and long-term potential. C. VGT's focus on tech stocks means it experiences high volatility. When tech is booming, VGT sees massive gains. But when the tech sector takes a hit, so does VGT. For example, in recent years, we've seen swings of over 30% in its price. SCHD, however, is built for stability. It invests in companies with strong dividend histories, which means it's less prone to wild swings. During market downturns, SCHD holds its ground much better than VGT. If you're okay with some risk and chasing high returns, VGT might be your pick. But if you prefer steady, reliable growth with consistent dividend payouts, SCHD is the safer bet. Now, let's look at actual numbers. Year to date, VGT has gained around 10.3%, while SCHD has returned about 5.19%. Over the past year, VGT saw a 35.9% return, while SCHD returned 14.12%. But what about long-term performance? Over 10 years, VGT has absolutely crushed it, delivering a nearly 488% return. Meanwhile, SCHD has provided solid but more moderate gains, averaging a 113% return. So, if long-term capital appreciation is your goal, VGT is the clear winner. But if you're more interested in steady income through dividends, SCHD might be the better option. Speaking of dividends, this is where SCHD shines. It currently offers a 3.34% dividend yield and has a strong history of dividend growth, averaging about 10.87% per year. That means your income stream grows over time, making SCHD an excellent choice for passive income seekers. VGT, on the other hand, offers a much lower dividend yield of around 0.68%. This ETF is not designed for income, it's built for growth. So, if you're looking to reinvest dividends and build a passive income stream, SCHD wins hands down. Let's now take a look at how a $10,000 investment would grow over time. If you invest $10,000 into SCHD today, in 30 years, that investment could grow to around $484,000, generating over $25,000 per year in dividends. Meanwhile, the same $10,000 in VGT could skyrocket to over $2.1 million in the same time frame. However, the downside is that it won't provide you with the same level of consistent income as SCHD. Don't have $10,000 to invest up front? No problem. With consistent monthly contributions, you can still reach these targets. To achieve a $2 million portfolio with VGT, you'd need to invest about $130 per month. Similarly, to build a portfolio that pays over $25,000 annually in dividends with SCHD, you'd need to invest around the same amount. This highlights the power of consistent investing and compounding growth. So, which ETF is better? It depends on your goals. If you want explosive growth and can tolerate volatility, VGT is your best bet. If you prefer stability and consistent passive income, SCHD is the smarter choice. Ultimately, a combination of both could be the best approach, using VGT for growth and SCHD for income stability. So there you have it. VGT versus SCHD, two powerful ETFs with very different strengths. Which one do you prefer? Let me know in the comments below. If you found this video helpful, make sure to hit that like button and subscribe for more investing insights. And if you want to learn how to turn just $25 per week into over $5,000 per month in passive income, check out the video on the screen now. Thanks for watching, and I'll see you in the next one.